Have you ever really stopped to think about what happens to your money after you deposit it? We tend to think of banks as these super safe vaults, right? But they are so much more than that. They're actually these incredibly sophisticated money multiplying machines. So today, we're going to pull back the curtain and see how they really work. So let's just start with a really basic question. You deposit your paycheck, you see that number pop up in your banking app, great. But where is that money really? Is it just sitting there in some digital vault with your name on it, just waiting for you? Well, the short answer is no. Almost certainly not. That whole image we have in our heads of a big vault filled with cash and gold bars, that is the single biggest misconception about banking. The truth is, your money is almost never just sitting still. It is out there in the world, constantly moving. And this brings us to what I like to call the great deposit illusion. Because once you wrap your head around this one core concept, everything else about how banks operate, and more importantly, how they make so much money, it all starts to click into place. Okay, so the system that makes this entire thing possible is called fractional reserve banking. And honestly, it's pretty much exactly what it sounds like. Banks only have to keep a tiny fraction of your deposit in their reserve. The rest of it, the vast majority of your money, it gets lent out. Let's just follow the money for a second. Say you deposit $10,000. The bank might keep 1,000 of that in reserve, but it immediately lends out the other 9,000. Now, here's the magic trick. That $9,000 doesn't just vanish. The person who borrowed it spends it, right? And whoever they paid then deposits that money into their bank, which then, you guessed it, repeats the whole process, keeps a fraction, and lends out the rest. And this cycle just keeps going, rippling through the entire financial system. This amazing ripple is what economists call the money multiplier effect. Your single deposit becomes the foundation for this huge inverted pyramid of new credit. So your money isn't just sitting there. It's actually the seed that allows a much, much larger amount of money to be created, seemingly out of thin air, all across the banking system. Okay, so the bank is using your deposit to create all this new credit. But how do they actually turn a profit on that? Well, let's get into their two main profit engines. So, the absolute core of a bank's business is something called net interest income. And the concept is beautifully simple. They pay you a low interest rate on your savings, and they turn around and charge borrowers a much higher interest rate on their loans. That gap, that spread between the two, that is their fundamental profit. And this table really lays it all out, doesn't it? Look at this. The bank might pay you, 1, maybe 2% on your savings if you're lucky, but then look what they charge people who borrow. 6 or 7% for a mortgage, up to 12% for a car loan. And don't even get me started on credit cards. We're talking 20%, sometimes almost 30%. That enormous difference is just pure, clean profit for the bank. And the scale here is just mind-boggling. A bank with, say, $50 billion in loans and a net margin of just 3%, that bank is earning $1.5 billion a year. And get this, that's before they charge you a single fee. Right, because that interest income is just the beginning. The second major profit engine, and it's a big one, is fee-based income. This is an absolute goldmine for banks because it's a super steady source of cash that doesn't really depend on whether interest rates are going up or down. I mean, just think about it. You've got your monthly account maintenance fees, those painful overdraft fees, fees for using the wrong ATM, fees for wire transfers, penalties for paying a bill late, and it keeps going. They take a cut when you exchange currency, they charge you just to start a loan, they have annual fees on credit cards, and they even get a tiny slice called an interchange fee from the merchant on every single purchase you make with a card. It all adds up to a literal mountain of cash. And for the really big banks, it gets even more complicated. They're trading stocks and bonds, they're managing huge portfolios for wealthy clients, and they're doing this thing called securitization. That's where they bundle up thousands of mortgages, sell them off as a package to big investors, and immediately get all their cash back. So they can turn around and, you guessed it, lend it all out again. But here it is. This is probably the most important piece of the entire puzzle. They're making all this incredible profit, right? But they're not doing it with their own money. They're doing it with your money. This is the real secret sauce of banking. It's called leverage. This visual really says it all, doesn't it? For every single dollar of its own money that a bank puts up, it might be using 10, 15, or even more dollars of depositor money. That's our money. It makes banking one of the most highly leveraged businesses on the entire planet. And this is what shoots their profits into the stratosphere. Look, earning a 2% margin is fine, but earning that same 2% margin on a giant pile of money that's 10 times bigger than your own, well, suddenly your actual return on the money you invested is a staggering 20%. That right there is the awesome power of leverage. So, hearing all this, you might be thinking, whoa, this sounds kind of risky, right? I mean, if a bank has lent out most of its deposits, what happens if a ton of people all want their money back at the same time? That's called a bank run, and it leads to a really important question. Why don't banks just collapse all the time? Well, the modern system actually has several really powerful safety nets built in to stop that from happening. First up, there's the central bank backstop. Basically, if a bank is running a little short on cash on any given day, it can borrow emergency funds overnight from the country's central bank, like the Federal Reserve here in the US. The second safety net is probably the most important one for all of us. It's government-backed deposit insurance. In the United States, the FDIC guarantees your deposits up to $250,000. This is the ultimate tool to prevent panic, because if you know your money is 100% safe no matter what happens to the bank, you have absolutely no reason to run and pull it out. Third, there are really strict international rules that force banks to have their own rainy day fund. They're required to hold a thick cushion of their own capital that's strong enough to absorb big, unexpected losses if a crisis hits. It makes the whole system that much safer. And finally, there's the interbank lending system. Banks are literally lending money back and forth to each other all the time, overnight, just to make sure that everyone's books are perfectly balanced at the end of every single day. It's this huge, interconnected web that keeps cash flowing smoothly through the whole system. So when you put it all together, you really see the full picture. Banks aren't just vaults. They're these powerful engines that take our savings and transform it into fuel for the entire economy. And the real genius of the whole model is this. They do it all using your money at a massive scale and all while being protected by the government. So, this system is really a marvel of financial engineering. It's designed from the ground up to be both incredibly profitable and surprisingly resilient. Now that you actually know how the machine works behind the scenes, there's really only one question left to ask. What will you ask your bank?